Hello traders, welcome to yet another episode of the free Smart Money Concepts course. In this episode, we will learn an advanced tutorial on a rather interesting smart money concept which is regarding the identification and utilization of flip patterns and flip zones. So in this video, I will talk about flip zones, the different types of flip entry models, and I will also give you the important rules to identify and mark valid flip zones. These are powerful concepts in smart money strategies, and neglecting them in your trading may leave you lagging behind the changing market trends. So, by understanding and utilizing these essential techniques, you will gain the adequate expertise to identify high probability flip setups, and you will also be able to make well informed trading decisions. So, if these series of videos are useful for you, then give this video a thumbs up to show your support, and make sure to subscribe to our channel and also enable the bell notification to get all the latest updates. So without wasting any time, let's get started. As the name suggests, the term flip in the flip pattern indicates a market transition from one direction to the other, thereby implying a change in the market sentiment. This could be a shift from bullish to bearish or vice versa. Flips are often viewed as crucial turning points or areas where the traders have potential opportunities to capitalize on the changing market dynamics. The flip trading entries are considered as an effective method to enter quickly during market declines or surges. So, how can you define a flip pattern? You can think of a flip pattern as a particular price pattern or configuration on the price chart that indicates a potential shift or flip in the market direction. Flips signal a transition from an existing trend to a possible reversal, or it indicates a shift in the market sentiment. So the overall idea of a flip pattern is simple. A flip pattern involves reacting to a significant price zone in the chart and then effectively breaking through it. These significant price zones could be support or demand areas, order blocks, gaps, important highs or lows, etc. Now, the flip patterns are majorly divided into two main categories. These are reversal flip patterns and continuation flip patterns. We will talk in detail about each one of them. First, let us look at how we can spot a reversal flip pattern. Let's imagine a bullish market structure with a consistent formation of higher highs and higher lows in prices. To identify a valid flip pattern, we have to consider a few key criteria. First of all, the price should face a rejection from a higher time frame supply zone. So when you mark the structure on higher time frames like 1 day or 1 hour or any higher time frame based on your trading style, you will be able to identify such price zones where we can expect the price to face some resistance. These could be major resistance areas, unmitigated higher time frame bearish order blocks, price gaps, daily, weekly or monthly highs, etc. All these levels or zones can act as a supply zone and reject the prices. Now, after encountering a resistance at the supply zone and declining, the price should retest the last formed demand zone and then move upwards, showing a rejection from this demand zone. But the crucial thing to make sure is that the price should not establish a new higher high, but instead, the price should break through the previously tested demand zone. This break of the demand zone forms a new supply zone, which is referred to as a flip zone. This flip zone is marked on the basis of an imbalance formed while breaking through the demand zone. We will talk about how to mark a flip zone in a short while. It is vital that we closely monitor this newly formed flip zone since the likelihood of price returning back to retest this zone is very high. It is usually recommended to place a sell limit order within this supply flip zone to enter into a short trade position when the price retests the flip zone. The same principles apply in a bearish scenario. In case if the market is consistently making lower highs and lower lows, thereby indicating a bearish market trend, then we will wait for price to find a support on a higher time frame demand zone and then move higher. This demand zone could be an unmitigated higher time frame bullish order block, a major support level, price gaps, daily or weekly or monthly lows, etc. As the price decline lower, it should react with the last formed supply zone on the same time frame that we are analyzing and then move lower. But the crucial part is to make sure that this price reaction should not establish a new lower low, or it should not form a bearish break of structure, but instead the price should break through the previously tested supply zone. This break of the supply zone will form a new demand zone, which is called our flip zone. Marking the flip zone is based on price imbalance formed during the supply zone break. We should closely monitor this flip zone because there are high chances that the price could return back to retest this zone. It is a usual practice to place a buy limit order within this demand flip zone so as to enter into a long trade position when the price retests the flip zone. Here, I would like to highlight a key point. A flip pattern wouldn't exist without a reaction from the last demand or supply zone. At least some of you might look at this and ask me, isn't this a change of character? Although the flip pattern shares similarity with change of character pattern, not every change of character is a flip. But on the opposite, every flip is a change of character. Actually, a flip is a specific type of change in the market dynamics where the price reverses and establishes a new structure. This pattern, as I have already mentioned, is characterized by a clear rejection from the last supply or demand zone, followed by a subsequent break of that price zone, creating a flip zone. Setting up trades for the flip pattern is similar to those setups that we have for a change of character pattern, thereby allowing the use of both aggressive and conservative entry types with the flip zones. We will not delve deep into each of these entry types in this video. We will talk about all the entry types and risk management strategies in the next season of Smart Money Concepts. But now, let's briefly analyze the flip pattern through a detailed candlestick analysis and come up with some rules to identify the best reversal flip patterns. It is observed that the flip pattern's effectiveness is greatly enhanced when the price reacts aggressively and push away from the demand or supply zone and then swiftly breaking through either the last demand zone or the last supply zone, thereby leaving behind an inefficiency. We have already made a video about inefficiencies or imbalances or fair value gaps in this course. You can check it out if you want to know more. If you have spotted an imbalance or inefficiency in price while breaking the supply or demand zone, then all you have to do is to find the extreme candle formed during the price pullback from the supply or demand zone before the price break through the supply or demand zone. You can mark the highs and lows of this candle using a rectangle, and this will be our flip zone. It is even better if this extreme candle is followed by a large bodied imbalance candle. But just keep in mind that the breakout move should be associated with a price imbalance. We will understand the reason for this in a short while. Now, it is crucial to recognize the fact that the strength of demand or a demand zone can be assessed by the level of rejection that it provides to prices and its ability to drive price to new higher highs. If the demand associated with the zone is weak and it fails to generate substantial momentum and eventually leading to a break through the zone, then it signals a shift in control towards the new supply zone, or we can say that the bears are gaining dominance. So as SMC traders, we can concentrate on trading the supply side of market in these situations. On a similar note, the strength of a supply zone can be gauged by the level of rejection it provides in pushing the prices to form new lower lows. If supply turns out to be weak and it fails to produce substantial price momentum and thereby eventually leading to a break through the zone, then it signals a shift in control towards a new demand zone, which indicates that the bulls are gaining traction. So as an SMC trader, you can focus on trading the demand side of market, that is, look for long trading setups. Now, let's outline some rules and other criteria for identifying valid and high quality flip patterns and zones in the market. I will discuss 4 essential rules that you can follow in order to identify valid flip patterns and zones with a high probability of success. The first rule states that for a reversal flip pattern to be considered valid, the price must first mitigate and reverse from a higher timeframe supply or demand zone. This rejection from the higher timeframe supply or demand zone indicates the possibility of a change in the market sentiment, thereby setting the stage for a potential flip to occur. In other words, the price should react from a significant supply or demand level before forming the flip pattern. So if the price fails to mitigate a higher timeframe supply or demand zone and then simply forms a flip pattern, it cannot be considered a valid flip pattern. Now let's talk about rule number 2. This rule states that for a valid flip pattern to occur, the price must react from a supply or demand zone, create a pullback, and then break through the supply or demand zone. Without a pullback or any rejection of price from the supply or demand zone, the pattern cannot be considered as a valid flip pattern. Moving on to rule number 3, This is a very important criteria that needs to be satisfied. It states that a high quality flip pattern should create a significant imbalance or inefficiency when flipping a demand or supply zone. This imbalance or inefficiency should be associated with a clear change of character, or in other words, it should involve a swift, powerful price movement that invalidates the previous market sentiment. Let us understand the reasons why this is very important. Imbalance represents an inefficiency between buyers and sellers, leading to a disequilibrium in prices that needs to be filled. Often imbalances are seen as a gap within the candles. These are also known as fair value gaps. To understand this better, we will consider two scenarios. If a 3-candle sequence, as shown here, lacks gaps between the high of the first candle and low of the third candle in case of a bullish scenario, and if a 3-candle sequence lacks a gap between the low of the first candle and high of the third candle in case of a bearish scenario, then these are examples of efficiency in the market. This means the price action is balanced and there is no imbalance or inefficiency that needs to be filled. Conversely, the presence of a gap within the first and the third candle, as shown in these scenarios, signifies an inefficiency or imbalance in prices that need to be filled in order to balance the price action or to make the market efficient. Therefore, the presence of an imbalance during the supply or demand zone break will increase the probability of the price returning back to fill this inefficiency, which will in turn improve the chances of our flip zone being tested. I hope things are making sense. Now the last rule, that is rule number 4, emphasizes that a valid and high probability flip zone must be unmitigated. It means price should not test our flip zones when moving to break through the supply or demand zones. Flip zones are considered as one-time use thing, just like order flow or order block areas. We will focus on only those trading opportunities when the price first enters a flip zone. Once a flip zone has been mitigated, meaning the price has moved beyond its boundaries, and the inefficiency associated with it has been filled, it will lose its significance as a trading area, and we will not consider it as an area or price of interest for our future trades. And subsequent retests of flip zone may not offer the same trading opportunities as the initial trade entry. Now, we can use aggressive or conservative entries when trading with the flip setup. As I have mentioned before, we will cover different SMC entries and risk management strategies in the second season of this SMC course. But to give you a general idea, while trading the reversal flip setups, take a short trade from or within the supply flip zone and take a long trade from or within a demand flip zone, and price pulls back to fill the inefficiency formed during the breakout. Now that we have extensively discussed the reversal flip pattern, let's explore the specifics of the second flip pattern type, which is the continuation flip pattern. The continuation flip pattern can be divided into two types. It can be either a supply to demand flip pattern or a demand to supply flip pattern. Let's begin with the supply to demand flip pattern. The supply to demand flip pattern is a type of continuation flip pattern that involves a price transition from a supply zone to a demand zone. As the name suggests, it implies a shift from a supply zone to a demand zone. This flip pattern indicates a decrease in the selling pressure and an increase in the buyer control or dominance, thereby suggesting a potential continuation of the bullish trend. Traders spotting this pattern can seek opportunities to enter long trade positions as the price reverses from the supply zone and move towards a demand zone. Now let's look into this scenario in greater detail. For this, let us consider a bullish market where the price has mitigated the extreme demand zone or the extreme bullish order block and begin to reverse, thereby continuing its upward movement towards the next unmitigated higher time frame supply zone. However, in this scenario, an interesting twist unfolds. Instead of respecting this unmitigated supply zone and reversing lower, the price sharply surges upwards, breaking through the supply zone. So this break of the supply zone indicates a lack of bearish momentum to sustain the selling pressure. It also implies that the bulls have taken control, thereby suggesting a potential continuation of the existing bullish trend. This scenario creates a perfect demand zone that is generated by the price wave that flipped the supply zone. So the new demand flip zone can be marked as the extreme candle in the price wave that caused the break above the unmitigated supply zone. Also keep in mind that here also the price needs to form an imbalance or inefficiency during the breakout wave. Typically, after such a flip pattern formation, the price may return to this flip zone to mitigate it and then resume its upward movement. The reason why price returns to this flip zone is due to the imbalance created by prices during the inefficient breakout move. This is what we call a supply to demand flip pattern. It signals a shift in market dynamics from selling pressure to buying pressure, presenting a potential opportunity for traders to consider entering into long trade positions, thereby anticipating the continuation of the bullish trend. Similar concepts apply to demand to supply flip pattern as well. Let's talk about it now. In this pattern, the price shift from a demand zone to a supply zone, suggesting a decrease in buying pressure and an increase in the selling interest, thereby indicating a potential continuation of the prevailing bearish trend. In this scenario, we have a bearish market where the price enters the extreme supply zone and starts to reverse, continuing its downward movement towards the next unmitigated higher time frame demand zone. However, something interesting occurs in this situation. Instead of respecting this unmitigated demand zone and reversing higher, the price sharply pushes downwards and breaks through the demand zone. This break of the demand zone indicates a lack of the bullish momentum in the market, thereby signaling a shift in control from buyers to sellers. This creates a perfect supply zone that is generated by the price wave that flipped the demand zone to the downside. So the new supply flip zone can be marked as the extreme candle in the price wave that caused the break below the unmitigated demand zone. In this case also, price needs to form an imbalance or inefficiency during the breakout price move. Typically, after such a flip pattern occurs, the price may retrace back to our flip zone to fill the inefficiency and thereby even mitigate the supply flip zone before resuming its bearish movement. So this is what we refer to as a demand to supply flip pattern. It denotes a shift in the market dynamics, suggesting a potential opportunity for traders to consider entering short positions, anticipating the continuation of the prevailing downtrend. Now, let us look at an example. Here, we have a 1 hour time frame chart. The price has formed a series of bearish breakout structures, indicating a bearish trend. We can also notice an unmitigated demand zone in the 4 hour time frame. Upon reaching this higher time frame demand zone, many traders would expect a potential reversal and they would start looking for signs of a change of character to enter into long trade positions. But contrary to their expectations, price taps into the 4 hour demand zone, experiences a minor pullback, and it crashes downward with significant momentum. This aggressive price move is associated with inefficiencies or imbalances that needs to be filled to regain the balanced price action. This movement causes a flip in the demand zone, indicating a shift in the market dynamics and potentially signaling a continuation of the bearish trend. We can mark this newly formed supply flip zone at the extreme candle of the inefficient price wave that caused the break of the higher time frame demand zone to the downside. The break of the demand zone also signals a lack of bullish momentum, indicating a shift in control from buyers to the sellers. And as you can see on the chart, the price retraces back to the supply flip zone, experiences a reaction, and then aggressively move downwards with significant momentum. Traders can look to take short trades from within the supply flip zone formed. So this is all you need to know about supply and demand flips. If you have come this far, thank you for watching this video. I hope you have found this video informative. If it was useful, please make sure to like and share this video with your friends and fellow traders. Also, don't forget to hit the subscribe button and turn on the notifications to stay updated on our latest videos. We value your feedback and suggestions, so please leave your comments below and let us know what topics you would like us to cover in our future videos. I appreciate your support and I look forward to seeing you in the next episode. Till then, bye.